let's talk about the Quant fund that you have. So how is UTI Quant fund different from other Quant funds?
We have developed 4-factor model based on price to earning ratio, price to book value, dividend yield, and yield gap of broader market indices.
How do you rebalance the allocation?
The factor-based smart beta funds have delivered somewhere between 2 to 5% annualized alpha as compared to broader market. You have to use right data for right strategy. Anything which is data-driven could be clubbed as quant fund. The market cycles, different factors tend to do.
What is the responsiveness of this model?
It will be diversified across factors. So which means typically consistency of outcome could be much more superior. On 3-year rolling basis, this particular product is outperforming 90% times based on vector results.
Being a rule-based strategy, what is your role when it comes to management? First of all, thank you for this opportunity. It's a good opportunity to pick your brains. Without further ado, let me get on to the questions. My first question would be to understand. So it's a very unique position that you are currently managing, being the head of passives in UTI, one of the well-known firms in the country. So what was your professional journey like? How did you end up in this space of investments, fund management, etc.?
So after passing out from B school, so I joined UTI and I worked across different investment functions, be it research and portfolio analytics, and then for last 7-8 years I'm managing these funds, passive funds, and then subsequently we started launching a lot of quant-based strategies as well. So that's my journey about investing.
When did you start investing? So into this field of investments?
For last 19 years to be precise.
Around 2 decades.
Yes.
Okay, so since you're the head of passive, so let me directly dive into the passive space. So the funds, the passive funds in UTI, so are they purely following the index, or is there an in-house model that you follow when it comes to management?
Sure. See, role of passive is to replicate the benchmark, because end of the day, passive funds need to generate returns which are very close to the benchmark. It is possible if you replicate the portfolio in line with the benchmark. So we have plain vanilla market cap oriented passive funds. Then we have a lot of factor based passive funds, wherein based on certain rules you are constructing the portfolio, but rules are very well defined. Apart from passive funds, we are also having quant oriented strategies which are basically rule based, but at the same time rules are defined internally. So we have both kind of passive as well as quantitative based funds.
Got it. So connecting to the passives, if you look at countries like the US, where passives are the most invested funds out there with the highest AUM, do you think India, a developing nation, is going to evolve into that model? Because in India, the highest AUM is in actively managed funds. Do you think that shift is going to take place?
Yes. See, when we look at global markets such as US, passive is bigger than active. We are seeing similar trends emerging in India as well. Size of passive was just about 1% of mutual fund industry's AUM 10 years back, but in last 10 years we have seen AUM increasing on passive side as well. So currently passive is 17% of mutual fund industry's AUM. If you ask me where we are headed from next 10-15 years perspective, about 15 years back US was also a similar level. So if we walk that similar path 15-20 years down the line, we could be as big as passive could be as big as active in India as well.
Got it. And do you think amongst the passives, do you think smart beta is going to have the highest allocation or highest AUM?
See, we need to understand there is role for both plain vanilla market cap based index fund as well as the smart beta fund. Typically, large retirement funds and larger funds which wants to generate broader market return, right? They will broadly invest large sum of money in plain vanilla market cap based fund. But retail, HNI, family offices, and in a sense these platforms could choose to invest in the different factor based strategies in order to generate better returns or better risk adjusted returns for their investors. So there is scope for both. So overall scheme of thing, factor based smart beta fund is smaller in nature, but in terms of growth, the growth is much faster as compared to plain vanilla market cap based.
Got it. So from a returns perspective, smart beta funds have the capacity to generate higher returns than a plain vanilla. Can I
see, objective of different smart beta fund is different. When we look at longer term outcome or track record of these factor based strategies, let's say in India we have around 20-year data. So in last 20 years, all the factor based smart beta funds have delivered somewhere between 2 to 5% annualized alpha as compared to broader market. But objective of different smart beta fund could be very different. Let's say for momentum based smart beta fund, objective is to generate higher returns during trending market. while let's say a low volatility kind of strategy wherein objective is to generate better risk adjusted returns. Absolute return may be slightly weaker at times, but on risk adjusted basis returns could be better. So objective of different smart beta funds could be different, but typically from long term perspective, aim is to generate better returns as compared to broader market cap based.
Got it, makes sense. Let's talk about the Quant fund that you have. So how is UTI Quant fund different from other Quant funds, and what is the strategy or the model that is that works in the Quant fund? If you could give us some more insights on that.
Sure. See, quant is a very broad area. Anything which is data driven could be clubbed as quant fund. UTI Quant Fund, we are dynamically allocating money across 4 factors like momentum, low volatility, quality, and value, because we have seen time and again that in different equity market cycles, different factors tend to do well. So we have modeled performance of these factors from long-term perspective, and we have developed UTI factor allocation model, which is guiding us a different allocation in different equity market cycles across all these 4 factors. So you can say that UTI Quant Fund is broadly dynamic factor allocation kind of strategy within overall quantitative parameters.
Got it. So, just like you said, markets have cycles and different factors perform well at different phase of the economic cycle as well. So, if you're looking at that point of view, what is the responsiveness of these models? Because suppose at the current market level, we'll have momentum of say 50% of the entire strategy. Just in case the strategy factor is going to change because cycles are there. Now, what is the responsiveness of this particular model?
Sure. So the way we are approaching in quant fund is, we have seen that from near-term perspective, factors could exhibit a lot of volatility. Right. Whenever trends are not in favor of those factors, certain factors could go through difficult phase, and whenever trends are favorable, those factors could perform well. So we are aiming to generate consistent outcome. So we are approaching this particular strategy mainly from all weather kind of strategy, wherein this could be core part of any client's portfolio, because based on historical trend, it will choose right factors at the right time. And the aim is to select factors which are likely to perform well over next to 3 years perspective, based on historical evidence. So, and allocation will be diversified across factors. So which means typically consistency of outcome could be much more superior as compared to individual factors. So that's what we are trying to offer through this particular product.
Got it. So I believe backtesting has to be done before the fund was launched. So if you could tell me, what was the testing framework? What was there a stress test wherein the particular factor went through different cycles out there, and how was it done? If you could walk us through the testing framework.
Sure. So we studied global markets as well as India. So in India, we have almost 20 odd years data. So we studied these factors performance over last 2 decades, and based on which we have decided on a particular framework, and mainly from consistency perspective, that let's say typically we advise people to invest in equity funds for 3 years perspective. So a framework which could give me consistent outcome over 3 year perspective, we have approached from that perspective. If you look at backtested results also, on 3 year rolling basis, this particular product is outperforming 90% times based on backtested results. So that's what we are trying to optimize through this particular product.
Got it. So because these are rule based strategies, what is, you as a fund manager being head of passive and you're managing quant and multi-asset, being a rule based strategy, what is your role when it comes to management?
Sure. So role of portfolio manager in such fund is to frame those rules. See, so human efforts has gone in terms of framing those rules based on data, because there are abundance of data available in the marketplace. We have to use right data for right strategy. So role of portfolio manager is to frame those rules and construct this particular portfolio based on those rules.
So are those rules dynamic? So do you think once the rules are formed, during a certain market cycle, do you think you'll have to make certain changes, tweak it?
Okay. See, any model needs to be adaptive.
Correct.
As in when we get more data, the model will learn better, right? Even machine learning, if you get more data, the robustness of model improves further. So as and when we get more data, we will adapt those trends in the marketplace, and so that portfolio outcome could be even optimized further.
Got it. And when it comes to your multi-asset allocation model, how do you decide which asset should have highest allocation? How do you rebalance the allocation?
Sure. See, multi-asset allocation fund has 3 asset class: equity, fixed income, and gold. We have certain range of allocation for each of these 3 asset classes. For example, Equity range of allocation could vary from 40 to 80%. Fixed income and gold could vary from 10 to 25%. Within this range of, let's say, 40 to 80% of equity, we have developed 4-factor model based on price to earning ratio, price to book value, dividend yield and yield gap of broader market indices. The idea behind selecting these 4 factors is these 4 factors are having consistently high correlation with future market, which means typically whenever valuations are attractive, future market returns could be better based on historical evidence. So this is 4-factor model which is guiding us asset allocation for equity. So it's quite dynamic. For example, when market was at peak in September 2024, we had 47% allocation towards equity. During this market fall in last 6 to 9 month period, allocation towards equity has increased from 47% to 62%. So in the sense, model looks at valuation framework at different time period and accordingly guides us on asset allocation.
So in this, you do have the liberty to explore silver as well when it comes to your overall asset allocation. What's your take on silver? Do you think you're bullish on silver, or is it an area where you still are exploring?
Sure. So currently we don't have, in the sense, scope to invest in silver. The 3 asset class defined are equity, fixed income, and gold. Right. So these are the 3 asset classes. Typically, reason for having allocation towards gold is because from long-term perspective, gold is having negative to low correlation with the equity. So which means if you are having certain proportion of gold in your portfolio, long-term portfolio outcome could be much more stable. So that's how we are approaching when it comes to asset class.
Got it. So this is what I asked to all the fund managers. So if you could let me know what is your personal asset allocation. If you could give me a percentage asset allocation towards equity, fixed income, real estate and all, that'd be great.
Sure. So apart from the house which I am living, primarily my allocation is there towards equity and some bit on fixed income. Primarily equity, large portion is in equity.
Majority is in equity. Yes. So if you could give us a percentage wise?
Broadly about 80% within equity and fixed income, 80% could be equity, and fixed income, I'm saying arbitrage I'm considering as part of fixed income because return characteristics are similar to fixed income.
So one last broader question and then we'll get on to the rapid fire questions. So recently Trump came up with the 25% tariffs. So how do you think it's going to affect our portfolios or the impact on our economy? Or do you think is there going to be an impact on our economy?
So see, this is interim arrangement. Ultimately, in the sense, India and US both are trying for FTA. So as and when that happens, probably these taxation could modify. But currently, most assessment are suggesting that there could be 10 to 20 basis point impact on GDP if this continues for a longer period of time.
So we have to wait and watch how it pans out.
Yes, you are hearing some or other news. Research are suggesting that the impact will not be meaningful. The reason being, export to US is just about 2% of GDP. Right? US is applying taxation on a lot of economies. And see, global investors are looking India as a China plus kind of model. So they want to diversify away from China to some extent. And since our allocation in overall global trade is pretty small as compared to other economies, other large economies. So in the sense, from that perspective, the impact on India is much more limited as compared to other economies.
Makes sense. So let's get on the rapid fire questions. The first question would be, which factor do you personally trust the most? Say when it comes to momentum, quality, low volatility value, which factor do you think you trust the most?
See, it's based on equity market cycles, but in current cycles, we are preferring quality over other factors.
Quality, got it. And one myth about passive investing you wish more people understood?
So people believe that passive funds don't generate alpha. That's the myth. But we need to understand that objective of passive is not to generate alpha, but to generate asset class return. So that's the main objective of passive. While for whenever you want to generate alpha, you can choose to invest in certain active funds. So that's the big myth.
A global quant or index fund that you admire or track closely?
So globally, plain vanilla market cap based index like S&P is extremely popular because you are getting top 500 companies exposure which are listed in US through single fund.
Got it. And Excel, Python or Bloomberg, which is your go-to model when it comes to model reviews and testing?
So we use combination of Python and Bloomberg. Models are built on Python, but in the sense for review and all, we can look at Bloomberg also because all the Python outcome are transferred to Bloomberg, wherein from review perspective, both are used.
Got it. So what's more satisfying, a model that beats the benchmark every time, or a model that gives you constant returns irrespective of the market cycle? Which is more satisfying? I know this is just a hypothetical question.
So model which is consistently generating alpha, because see, we are after all in relative performance game, wherein objective of any portfolio is to beat the benchmark on consistent basis. So rather than optimizing or maximizing performance vis-a-vis benchmark in a particular time period, consistent alpha is what we are striving for.
That's it from my end. Thank you for this opportunity.